I think a lot of people are sitting on cash because they're scared and they're waiting for that right time to buy. There's not a problem with waiting to buy. You don't want to sit on cash while you're doing that. So while I'm waiting, for instance, for certain opportunities, I'm investing that money.
Yeah, excited to bring Evan Compean to the Real Estate Hacking Live today. Evan is an active real estate investor, private money lender, leads a boutique real estate team that did $45 million in volume last year. Recently started a second brokerage that focuses primarily on referrals nationwide. So welcome, Evan Compean, to
Thank
Real
you.
Estate Hacking Live.
Thank you, guys. I appreciate being here.
Hey, what's going on, Evan? Since we've last talked, I think you've like really upped your social game. Mega kudos on that. And I'm live on TikTok as well. So I know like your TikTok videos, like if you're not following Evan on TikTok, definitely do. But beyond that, inflation, real estate.
Yeah.
So you're a broker. You've got your team leader, and you're also a real estate investor. So you've got a pretty deep perspective on real estate, how it impacts you just in a normal market, but in this high inflation market, there's some unique challenges. How are you using real estate to beat inflation?
So the number one thing is I would say that you don't want to sit on cash. I think a lot of people are sitting on cash because they're scared and they're waiting for that right time to buy. There's not a problem with waiting to buy. You don't want to sit on cash while you're doing that. So while I'm waiting, for instance, for certain opportunities, I'm investing that money, investing it in either buying notes, lending it out to other investors, making 10, 12, even 18% on some notes when they're second liens. So I'm actively lending and I'm actively looking for opportunities because you do come across some opportunities now that are a lot more favorable than they were a few months ago. So doing a little bit of both, lending and then also looking for opportunities within real estate, but then also in the business as a whole. So just in the last couple of weeks, when we were chatting about this coming on the show, an opportunity to purchase a title company came up for me. So I'm actually working on that, on becoming a co-owner of a title company here in Houston and Dallas. So I'm looking for opportunities, jumping on them whenever they present themselves, regardless of how that opportunity looks.
Nice. Congrats on the title company venture. Just so you mentioned a couple different ways that you're investing in real estate, both actively, so you're actually buying properties, but also passively, which is through notes and maybe even I don't know I can't recall if you mentioned equity as well, but
that too.
What do you have a preference, especially in this market? Like, would you, if you had to choose one of those options because of maybe limited resources, would you prefer to actually be the active owner, or would you prefer to be more of a passive equity partner, like a limited partner, or a hard money lender, or like a private money lender?
I think it depends on just your overall capacity. Like me personally, I don't mind jumping into like equity participation agreements, being the hard money lender directly, being the second lien holder on something and not the first lien holder, because I'm comfortable assessing the deal overall. But if there's more limited resources, if you have 50,000, 100,000, then that's when you want to look maybe at buying notes instead, or you want to look at maybe just buying a rental property and maximizing that 100,000 and putting 20% down on maybe 2 properties or 3 properties, depending on what it is that you can get. I think you definitely want to spread it across a few different things. But if you don't have the bandwidth to really manage the tenants, then maybe just buying notes, buying a 50,000 or buying into a $50,000 note or $100,000 note that maybe pays you 8%, 9%, 10%. That can work out pretty well, because that's going to possibly beat or very likely beat the appreciation rate in real estate for the next 12 months, 18 months, maybe even 24 months. So you have that there to kind of gain from. So I would do that if there was more limited resources, but I would definitely also consider real estate if there was the right opportunity. And now there's even fractionalized investing that you can do in real estate
Yeah.
too. If you only have $100, but let's say you have 1,000, 10,000, you don't necessarily have to buy a note or real estate. You can get into fractionalized investing.
Yeah, Amazon's moving into that hot and heavy too. We'll see where they go with it,
Yeah.
but it's definitely interesting. Where how do you see over the next, like, say 12 months? You mentioned a lot of people are holding cash. From the real estate investor circle, we've heard this doomsday scenario I've heard it for years, like probably over the
Yeah.
last 4 years, like, oh, it's going to crash, it's going to crash. And then COVID happened, like, oh, it's going to crash. And it did the exact opposite. And then now, where we've got the interest rates have more than doubled over the past few months,
Yeah.
for 30-year mortgage, like it's going to crash. I keep hearing that. That has not happened. We are seeing a slowdown.
Yeah.
That's on
For sure.
paper. But where are you actually seeing, or do you see just normalization? Are you seeing where there potentially could be crashes, or maybe even certain sub-market crashes?
I think submarkets, yeah. I think, but only because they were extremely inflated to begin with. So it wasn't during COVID. You had certain markets, not necessarily Houston, and not even maybe necessarily Austin. Austin is very inflated, but other markets that really just peaked and inflated at a very fast rate, way outside any type of normal parameter.
So like the Phoenix home that normally
Yeah.
would have been 500,000 that was going for 8
Yeah.
within a 2-year period,
That
something like that.
Those types of markets, I can definitely see a crash in that, but only because it's somewhat normalizing, because you left the parameters of normal growth for a while. It's not like 2008, where even the run up there before 2008 wasn't like the run up during COVID. Now we don't have any of those dynamics that we had during the Great Recession with just the underlying mortgages and the adjustable rate, all of these other issues that really came to play and just really doomed the whole housing market. So I don't see a housing crash coming up. I do see normalization. I do see, like you said, some submarkets crashing, but again, kind of quote unquote crashing. But I think most of the markets we're just going to come down a bit. I don't necessarily think most markets are going to see pre-COVID levels, but I do think we'll come down from those highs because they were very inflated. It wasn't a normal market, and quite honestly, we never should have ever had 2.5% interest rates. That's what really screwed us. We should have never had that, and that was just a bad thing that happened to our market. People took rightfully advantage of it because it's what was out there. What were you going to do? But it just should have never been an option to have those types of rates under 3%.
Yeah.
It's just crazy. It's free money, basically.
Free money, and yeah, for those who got it, they're probably not selling anytime
No,
soon.
they're not.
And
No,
why would they?
exactly.
Well, yeah, I appreciate having you on, Evan, and we should get together again
Absolutely.
soon.
Yeah, absolutely. Thank you, Chris.
Absolutely. Take care.
All right, man. Thanks.